389 million ounces of paper claims, 103 million ounces of real, deliverable silver. One market, one exchange, and a depletion clock running at roughly 74 trading days. I want you to sit with those three numbers for a second before we go any further, because when I pulled up the COMEX data this week and laid those figures side by side, it stopped me cold. This is not a fringe analysis. This is not doom content. These are the actual registered figures from the exchange itself. And what they are telling us about the structural condition of the silver market right now is something every serious metals investor needs to understand before Monday morning. Stay with me, because around the 9-minute mark, I am going to show you the Shanghai premium data that confirms this is not just a Western paper market story. The physical buyers in Asia already know something. The question is whether the paper market catches up to them, or whether they catch up to it. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here, and everything I show you today comes from publicly available sources I will name as we go. Last week I told you to watch the Federal Reserve statement language, specifically whether Powell acknowledged the GDP revision to 0.7% in the fourth quarter and shifted tone towards stagflation. He held rates as expected, but the language around growth was notably cautious. That call hit. The stagflation framing is now entering the mainstream financial conversation, and as I am going to show you today, that matters directly for silver in a way most people are not connecting yet. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time. Because what we are building week by week here is a framework for reading these markets that the noise channels simply do not offer. Let me set the scene with where markets actually are right now. Silver closed Friday at 84.44 per ounce. COMEX front-month futures closed near 81.13. That is a discount to spot, which already tells you something important, and I'm going to come back to it in detail. Gold is at $519. Oil is above $100 a barrel. The dollar index is sitting near 99.97, and the 10-year Treasury yield is at 4.27%. That macro backdrop, a live geopolitical conflict, energy prices spiking, a strong dollar, and elevated yields, is the environment silver is navigating right now. And what makes this week's video different from a standard price update is this. Underneath all of that surface noise, the structural plumbing of the silver market is sending signals that go well beyond where the price closed on Friday. The question this video answers is not where silver is today. It is whether the market structure underneath today's price is stable, or whether it is quietly building pressure that the headline number is not yet reflecting. Before I get into that, drop something in the comments right now. Are you currently holding physical silver, mining exposure, or both? US and UK answers both welcome. I want to know how this audience is actually positioned, because what I am about to show you lands differently depending on where you sit. Let me start with the number that triggered this video. COMEX registered silver. And I want to be precise about what registered means, because this distinction matters enormously. Registered is the only inventory pool that is actually deliverable against futures contracts. It is not eligible silver, which sits in vaults but has not been cleared for delivery. Registered is the real stack, the stack that backs the paper. And right now, that stack stands at approximately 103 million ounces. Now here is where it gets interesting. Open interest in silver futures sits at 77,890 contracts. Each contract represents 5,000 troy ounces. Do that math and you get approximately 389 million ounces of outstanding paper claims, sitting on top of 103 million ounces of deliverable metal. That is a leverage ratio of roughly 3.8 to 1. Think of it like a car park with 103 spaces that has issued 389 parking tickets. Most of the time that works fine because most ticket holders never show up at the same time. The system runs on the assumption that delivery demand stays low and predictable. But when something changes that assumption, a geopolitical shock, a supply disruption, a sudden shift in physical demand, the car park cannot accommodate everyone who suddenly wants their space. And right now, the rate at which spaces are being vacated, registered stocks being drawn down from the vaults, puts depletion of that 103 million ounce stack at approximately 74 trading days at the current withdrawal pace. That is roughly 3.5 calendar months. That is not a distant theoretical risk. That is a structural condition that exists in the market today. The CME warehouse report is where I pulled this figure, and the date on that report is current to this week, so this is not old data. Now here is where the front-month futures discount to spot becomes critical. When I tell you COMEX front-month silver futures closed near $81.13 against a spot price of $84.44, what that gap is telling you is that the market is pricing near-term physical tightness. In a normal, well-supplied market, futures trade at a premium to spot. You pay more for future delivery because of storage and financing costs. That is called contango, and it is the standard condition. When futures trade below spot, when the near-term contract is cheaper than getting the metal right now, that inversion is called backwardation, and it is a classic signal of physical stress. It means the market is saying real metal available now is worth more than a promise of metal delivered later. Hold on to that, because in about 4 minutes the Shanghai data is going to show you the other side of the same story from a completely different geography. If you know someone who has been trying to make sense of the silver market this week and feeling like the price moves do not match what they are reading about fundamentals, share this video with them right now. The disconnect they are feeling is real, and this breakdown explains exactly why it exists. Now let me layer in the industrial demand picture, because this is the part of the silver story that separates it from every other metal in your portfolio. Silver is not just a monetary asset. It is not just a store of value you hold alongside gold. It has a second identity, an industrial identity, that creates a demand floor that does not move with sentiment the way investment demand does. Solar panel manufacturing is now one of the single largest and fastest growing consumers of silver globally. The Silver Institute's data shows that solar alone accounts for a significant and rising share of annual silver consumption. Add EV batteries, electronics, medical devices, and the physical infrastructure of AI data centers, all of which require silver in their connectors, contacts, and thermal management components. And you have a demand base that is genuinely inelastic. Industrial buyers do not look at a futures chart and decide to delay their purchase because the paper price dropped. They need the silver to build the product. They buy it. A plumber in Manchester does not check the copper price before fixing a boiler. He needs the pipe. He buys the pipe. Silver's industrial consumers operate the same way, and that inelastic floor underneath demand is one of the structural reasons the bearish case for silver requires significantly more force to play out than the bearish case for a purely speculative asset. The honest caveat, and you deserve this, is that manufacturers do find ways to reduce silver content per unit over time. Thrifting is real. But the Silver Institute data shows that deployment scale in solar and technology is growing faster than thrifting is reducing per unit consumption. The direction of industrial demand has not reversed. The UK's own renewable energy rollout, North Sea transition, domestic solar targets, puts British industrial policy directly in line with this demand trajectory. Here is the number that stopped me cold when I pulled up the Shanghai Gold Exchange data this week. Physical silver in Asia is trading at a premium of approximately $150 to $3 per ounce above COMEX quotes. And this premium has persisted since late 2025. That is not a one-day arbitrage anomaly. That is a structural signal that has been running for months. What it means in plain terms is this. Physical buyers in Asia are consistently willing to pay more for real silver than the Western paper market is pricing it at. They are not waiting for COMEX to tell them what silver is worth. They are pricing it themselves, and they are pricing it higher. Think of it like two fruit markets in the same city. One market is pricing apples at a discount. The other market across town has a queue of buyers paying a premium. Eventually, one of two things happens. The cheaper market runs out of apples as buyers migrate to where supply is, or the cheaper market raises its price to reflect where actual demand is. That is the dynamic playing out between the SGE and COMEX right now. And the 74-day depletion clock on registered COMEX stocks is what makes the first outcome, the market running short, a live structural risk rather than a theoretical one. The gold-silver ratio closed Friday at approximately 60.6 to 1. In 15 years watching currency and commodity markets, ratios at this level have historically preceded silver outperformance phases as the gap compresses. If gold reaches the JP Morgan target of $6,300 and the ratio compresses to 60 to 1, that implies silver at $105. A further compression to 50 to 1 implies silver at $126. I am not stating either of those as a price prediction. I am showing you the mathematical relationships so you can decide what the structural setup means for your own position. Neither outcome is outside the range of what the historical ratio has done before. All right, let me show you how I am actually thinking about this week, using the 3 lanes framework. This is how I separate what is noise from what actually matters, and I use it the same way every single week so you can track how conditions are shifting over time. Lane 1 is the paper market, the blue lane. COMEX open interest at 77,890 contracts against 103 million ounces of registered stock. Front month futures at $81.13, trading at a discount to spot. That backwardation signal in the near-term contract is the paper market's own acknowledgement of near-term physical tightness. The paper lane is not bullish right now in terms of positioning, but the structure of how it is priced is sending a stress signal. Lane 2 is the physical market, the silver lane. SGE premium of $1.50 to $3 per ounce, persistent since late 2025. COMEX registered inventory at 103 million ounces and drawing down. The physical lane is tight and getting tighter. Lane 3 is macro, the gold lane, 10-year yield at 4.27%, DXY near 99.97, GDP revised to 0.7% in Q4, Fed on hold with cautious language on growth, oil above $100 from the Iran conflict. The macro lane is a stagflation configuration, and stagflation historically supports hard assets including silver's monetary dimension. In 15 years watching these markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in the metals complex. I am not saying we are at full alignment today. What I am saying is the paper lane is showing stress signals, the physical lane is tight, and the macro lane is structurally supportive. 2 of the 3 lanes are pointing the same direction. The third is under pressure from dollar and yield headwinds that are real but not permanent. That is a framework for watching, not a guarantee of outcome. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. I am watching COMEX registered silver inventory for the next weekly CME warehouse report. Specifically, I am watching whether registered stocks drop below 100 million ounces. That is the threshold level. If we break below 100 million ounces of registered stock while open interest stays near or above current levels, the leverage ratio crosses 3.9 to 1 and the 74-day depletion clock accelerates. That would be a structural escalation, not a price prediction. But it would be the kind of data point that moves institutional attention toward the squeeze risk in a way that the current setup has not yet fully done. The CME warehouse report drops during the week. I will have it, and I will come back to it next video with the exact number. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what the report showed. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and stop being useful. The bullish case for silver right now is genuinely strong, and I want to be honest about why. Continued vault draws take registered stocks below 100 million ounces. Asian demand premiums widen further as the Iran conflict sustains energy and safe haven bids. Any disruption to silver supply chains from Middle East instability tightens the physical market further. Paper shorts in a thinning market face increasing cost and risk to hold their positions. If short covering triggers in a market where physical delivery demand is simultaneously rising, the move higher gets amplified fast. That is the squeeze scenario, and the structural conditions for it are more present today than they have been in years. Here is the bearish case, and I want to give it genuine weight because you deserve that. An Iran ceasefire removes the geopolitical bid. Dollar strength pushes through DXY 100.50 and compresses metals. Treasury yields move toward 4.40 or higher, tightening real yield conditions against gold and silver. Industrial demand slows if global growth continues to decelerate. In that scenario, silver tests $76 to $78, where the next major support structure lies. That is not a small move from current levels. Both cases are genuinely possible. The structural setup I have described today, the paper-to-physical ratio, the depletion clock, the Shanghai premium, makes the bullish case structurally supported in a way it has not always been. But structural support does not override macro headwinds in the short term. Your job is to watch which conditions are actually developing. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it every time I say it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach the people who are trying to navigate these markets without the noise. Hit it now. I want to ask you two things, and I genuinely want your answers. First, are you treating the 74-day depletion clock as a serious structural risk in your current positioning, or do you think the paper market normalizes before it becomes a delivery problem? Second, looking at the SGE premium persisting since late 2025, do you think Asian physical buyers are ahead of Western paper pricing right now? Or is the premium explained by local market factors that do not translate to a global squeeze? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going directly into the COMEX warehouse report numbers the moment they drop, and I will show you exactly how to read those figures in real time as a leading indicator for silver price structure. That is a skill worth having, and you will not find it explained this way anywhere else. And if someone in your life is holding silver right now and wondering whether the fundamentals actually support the price, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.